Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. I'm Michael Bull, your host to the world of commercial real estate. We're coming to you on 40 radio stations, iTunes, and YouTube, and the show website, commercialrealestateshow.com. Thanks for being with us. Today we're going to discuss the retail industry, retail real estate, and the retail investment market. Please welcome my first guest, Kevin Imboden. He's Director of Research with RC Analytics. RC Analytics does a fantastic job of tracking the investment market around North America. Kevin, thanks for joining us today.
Thanks for having me, Michael. Pleased to be here.
Well, we appreciate it. And Kevin, has retail really come back in vogue with investors? It seems that in our shop, the retail investment market has really picked up. What are you seeing for transaction volume around the country?
Well, we've seen a slight uptick this year so far in 2014. Year to date, we're looking at around $68 billion in volume. And to give you an idea of the increase over the past few years, in 2011, there was $45 billion in retail volume around the country, up to 58 in 2012, 64 last year, and another uptick this year. So there's been an increase, but it's leveling off a little bit, too. And perhaps to give another perspective on that, apartments, which are in some cases probably overvalued a little, are at $87 billion in volume, and offices at $96. So retail might still have a little bit further to grow.
Okay, so $68 billion so far this year that you've tracked?
That's correct.
And $64 billion last year. So seems like it's tracking real strong.
Right. And we still have another month to go, and usually after the end of the year, we get a little more information in, and we increase the total a bit more.
Right. Yeah. I guess do you see a little bit of a surge at the end of the year, the December closings, if you will?
Yeah, we tend to do that, and usually a lot of the brokers want to make sure they get their deals in at year end to make sure they account for our broker rankings, and so we usually see that uptick after the end of the year.
All right. Well, Kevin, what are you seeing, what are you hearing about retail that's making investors interested in the sector?
Well, there are a few things that are driving investor interest. It may not always be positive, but there are definitely things that investors are watching. For example, some of the big retailers, they now may be looking at changing their format due to the increase of internet penetration in retail. So if you're looking at some of the middle market retailers like a JCPenney or a Sears, will they still have the same number of stores in the following years? If you're looking at a mall that has one of them as an anchor tenant, would that be something you could repurpose? Would that be something where you'd expect them to be around? Would an open-air center be a better move over a enclosed center? I think that question is driving a lot of interest, too, because a lot of open-air centers have been doing quite well of late.
Okay. So one man's trash is another man's treasure, huh?
Certainly. And there's always opportunity where someone else may have left off. There could be one for you.
Yeah, that's right. Well, I think there is a lot of upside and a lot of change in the retail market, and especially when you look at online sales and how that's affecting the retail market, right?
Sure, and I think some of the retailers, the larger retailers, are taking advantage of this uptick in internet sales. They're looking to change their stores into a little bit more of a distribution hub as well, where they'll be able to do deliveries to local areas, or at least have some kind of pickup system where a customer could come into the store and pick up the goods that they've ordered online.
Yeah, that's a good point. And they're in good central locations in major urban areas. So if you're going to get quick delivery, these stores can be a good source. And some of them, have low rents depending, what types of centers and locations that they're located in, right?
Absolutely. Some of these anchor tenants have signed leases that are very old, they sometimes actually own their own stores, which helps a lot of times. And so they were able to develop their own store at a mall, have a very low responsibility for any kind of, I guess you could say, management of that mall or upkeep of that mall, and they're able to turn that into something that's profitable.
Okay. And is most of the volume institutional quality, or is it value add and B properties as well, Kevin?
Well, there's a pretty good mix we're seeing this year. So the large fortress malls that are usually considered the institutional quality assets have actually dropped a bit from $8 to $5 billion over the course of the year. But one of the proxies that I sort of use to determine what would be institutional quality would be the interest from overseas investors. And I've noticed that some of the overseas investors have bought very high-end, say, lifestyle centers. So that would be UBS, the Swiss fund, buying a center in the Bay Area in Emeryville for $289 million, or Jamestown, the German fund, buying a lifestyle center in D.C. for $272. But there's also the redev opportunities. So there are Chinese developers who are buying in L.A., New York, looking to redev in good locations and possibly do something mixed use. So there's a pretty good spread across what's interesting the institutional players.
Okay. And as you track these sales, what percentage of these sales are actually financed on the property level?
Well, a vast majority of them are. I've been tracking the CMBS market in great detail. We did a pretty good report in our half-year newsletter regarding this, and probably 82% of all malls that have traded, and those are those large fortress mall type centers, have been funded via CMBS. And that also includes that 59% of all tertiary markets have been funded, retail markets I should specify, have been funded via CMBS. So the CMBS market has been helping along retail considerably. Probably around mid 40% the past 5 years we've tracked of all retail deals are funded through CMBS. So that market is definitely driving some of these deals.
And what types of rates and loan-to-value ratios are you seeing out there?
LTVs for retail properties are a little different depending on what kind of lender is funding you. You'd have something like an insurance company that would probably only fund at a 60% LTV, all the way up to maybe a private loan from I guess we call them financial companies, for the ones we don't necessarily categorize, probably about 74%. With CMBS, around 66%.
Okay. And are you seeing some positive leverage on these deals, or are they getting a higher cap rate than their financing rate?
It seems like they have been, just because interest rates are so low. And so there still are some deals that to be had out there with financing, at least until interest rates rise.
Okay. And so when you talk to your clients and all over the world, and they're looking at retail properties, so they're bullish, even though they know that online sales is growing, they're really bullish on retail for the most part?
They're bullish if they feel that they can have some kind of, I guess, niche play that would be different from the usual. I think the usual for retail isn't going to work going forward. So if there's some kind of good inner city market, or if there's some sort of daily use component that would attract a shopper to the center, then that would interest an investor.
Okay, and we're talking with Kevin Imboden, Director of Research with RC Analytics, and we're talking about the retail investment market. And Kevin, the volume of sales, is it heavily proportioned to central business district and large urban areas, or are you seeing some suburban sales pick up?
Well, we've seen about $12 billion in CBD sales, as opposed to, say, like around $9 billion in suburban sales for the large centers. So definitely more of a transaction volume going to the CBD deals. The World Trade Center deal, for example, Westfield bought another 50% of the center that they didn't already own. Vornado just recently had a very large deal in Midtown Manhattan, where they bought a retail condo for over $28,000 a square foot. And that is some pretty impressive pricing. We only usually see that in, say, a Hong Kong or someplace like that.
Is that a record U.S. price per square foot?
It's got to be up there. What's interesting is that's still traded at a 4 cap, so the rents on that building are quite high.
Yeah, that's interesting. Let's talk about caps. What are some of the cap rates that you're seeing on some of these properties?
So retail as a whole, we're seeing around high sixes, mid to high sixes for the single tenant properties. There's been a bit of compression there over the last few years. The urban sort of locations have also seen compression down to around a 5.5 nationwide. And to give some perspective on that, in 2011 they were a full 1,000 basis points higher. We were looking at mid sixes back then. And then the lifestyle center component of retail, we're down to around 5.9 for the few centers that have traded. So the lessons from that is that the high-end retail buy is seeing a lot of compression, whereas some of the lower end, the unanchored centers, maybe the grocery centers, a little bit of compression, but not much.
Yeah, that's a good point. And of course, the cap rates will range for the property and location and the length of the leases around the country. We're talking about mainly core assets here. But, well, stay tuned. We're going to have more on retail and retail investment market. And if you're listening to the show on one of the radio stations around the country, be sure to check us out on the show website. You can see some charts going along with what we're saying. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about a retail industry, we're talking about the retail real estate fundamentals, and we're talking about the retail investment market. My current guest is Kevin Imboden. He's Director of Research with RC Analytics, and they track the investment market for all property sectors all around the world. And Kevin, before the break, we were talking about cap rates for some of the retail properties, and of course they vary for a location and tenant and the type of asset. So what are you seeing for cap rates on some of the major gateway markets compared to maybe some of the secondary markets?
Well, we're definitely seeing greater compression in the major markets. There's a lot of interest there coming from both domestic and international investors. So the spread right now between what we deem the 6 major metros and the rest of the country is probably around full 1.5%.
Wow.
But that's also being led by markets such as Manhattan, which this year especially I've just seen caps compress all the way from, well, it was probably about a year ago, the mid-5s down to the low 4s. So just in that short amount of time, we've seen huge compression there. We've also seen other markets such as the Bay Area be a little jagged and LA compressing a little bit too. So those markets in California are probably around 6s at the moment.
Mm-hmm. Okay. And what about in some of the secondary markets?
Secondary markets as a whole, you're probably looking at around a 6.5. We're still seeing some pretty decent values there, but that's also a huge decrease from where they were, say, in 2010, where you were looking at retail at over an 8 cap. And I think it's going to be quite a while before we see that again.
Right. And this increase in sales that you've been seeing in the retail market, is some of that because of the spread that you're seeing on cap rates between multifamily and retail? What would be an example, maybe in New York or maybe nationwide, on the spread between multifamily and retail right now?
Well, multifamily has attracted so much investor interest just because of the fact that people have moved out of houses for so long. We had that huge bust in the economy, people got foreclosed on, and people moved back into apartments, and rising rents, especially in major metros, got a lot of interest from a lot of the institutional players. So because the apartment sector is on fire and we're seeing a lot of 5s and 6s, retail is starting to look more attractive again, because retail properties could probably be more easily repositioned to have a value-add play, and so some of the larger institutional players are going that route.
Okay. Well, I think everyone's interested in retail, and it seems to be the most volatile sector, in my opinion, because of online sales and kind of that changing retail environment. So what's your expectations for cap rates and values moving forward in the retail sector?
Well, we've seen that compression slow the last year or two in most markets. Like I had mentioned, we have that Manhattan outlier, which has seen huge compression. But it seems like the rate of change has slowed a bit. So the question is, well, in some of these prime markets, are those now so overvalued that there's going to be a major movement into the secondary and tertiary markets? We've seen some of that here and there, but it hasn't been complete. There hasn't been like the whole cattle herd mentality into those markets. But I think the continued pricing of the core sort of office markets that have previously attracted the trophy investor, as well as the aforementioned multifamily, is going to lead to some continued interest in retail.
Okay, I think we're seeing that too. We're in the southeast, and some of these secondary markets that we work, we're seeing an increased interest from investors, and I guess they're searching for yield. And one of the things that's also on the mind of our listeners and viewers, I think, is the impact on the possible increase in interest rates on retail over the next few years. What are you seeing? What are you hearing? What are you guys predicting for the impact of interest rate increases on retail values?
Well, it's going to be similar to the rest of the commercial property sector. Will financing be more expensive because of the interest rate increase? Well, of course, but how much will the spread be in some of these markets? Will it be worth it to continue to chase that trophy asset? And also, another issue that I think has been overlooked is that there's a lot of CMBS debt still out there that was issued in 2005 to 2008 when the market finally ended, and that debt is coming due within the next, say, 3-4 years. That was all 10-year debt. So can that debt be refinanced? Have values gone up enough to equate with the large appraisals that were going on at that time? That's still sort of unclear.
Right. So I guess it depends on the fundamentals, right, on occupancy and rates and how much these values have improved over time and will improve between now and then.
That's definitely a part of it. And also, have we come to grips with just how overzealous some of those 2007 appraisals were? When we're looking back at some of our old data, some of those are a little out of line with even values today.
Right. And is there maybe less impact on these large core assets from interest rates, since a lot of these REITs and investors aren't really funding these with property level loans, or is that still going to have an impact on values?
It may still have an impact on values. So far, most of the REITs have had no problem raising funds, but that's because also the stock market has been just on fire lately. If there was a change there, then they may be impacted.
Okay. I guess one of the things that's helped retail and commercial real estate in general for values and occupancy and fundamentals is the lack of new supply, right? So is it time to build retail as the fundamentals have improved, and what are you seeing for new supply levels?
I think it might be time. There have been some development, especially in the outlet sector. Outlets have gotten a lot of interest. You have companies like Simon, like Tanger, who have done really well, not only building fresh outlets, but also expanding their current outlets. And that goes both in the U.S. and for our international audience worldwide. If the retail center is intelligently planned, it has that daily use component, the grocery store, the drugstore that's driving foot traffic into the center more often, or if it's an inner city location, then those look to be those opportunities that could pay off. But if it's the suburban mall, the far-out suburban strip center, if it's not grocery anchored, maybe not so much yet.
Yeah, that's interesting. I think people want an experience, right? They want to go to these malls and shopping centers where they can do other things and maybe eat at a kind of a chef-driven restaurant and just have other things to attract them to these centers, don't they?
Absolutely. Yeah. You can't always guarantee that someone's going to buy an expensive shirt or a wallet every day, but they definitely need to eat, and they definitely need to go to the drugstore.
That's right. Well, we're talking with Kevin Imboden with RC Analytics. And Kevin, where do you see opportunities for developers and investors at this point?
Well, I hate to sound a little redundant, but that would be sort of following up on the last question, where we're looking at the mixed use, the inner city development. If those sorts of opportunities are met, then I think the developer or the investor would be quite fortunate. Until demographics change, we're still seeing that those demographic shifts back into the inner city. And because of that, you have greater density. You should be able to obtain greater foot traffic in a lot of these areas.
And it sounds like from what you said that you may expect some more cap rate compression in the secondary markets or in some of these investors searching for yield.
That would be a guess on my part, certainly, just because of the pricing of some of these core markets has gone so high that at some point, whether it's the near future or the far future, there would be continued compression in the secondary and tertiary markets just because there's nowhere else for some of this money to go.
That's right. Well, Kevin, thanks for joining us today. We appreciate you being on.
Thank you so much, Michael. Thanks for having me.
For more information, visit rcanalytics.com and stay tuned with us. We're going to have Jesse Tron with ICSC, and we'll look at the retail industry. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Brokerage, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive suite of powerful commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. Sozo Web Hosting and Cloud Solutions. Secure, reliable, and worry-free. Visit sozo.com. That's SOZO.com. FIU, Florida International University. Earn your master's in real estate online in as little as 10 months. Visit FIUonline.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. For more information on these great companies or for additional podcasts, videos, or blogs, visit creshow.com.